The next smartphone you buy is going to cost you more money, and it will run slower than the one in your pocket right now. And the reason why starts 6,000 miles away. To understand the forces dictating your technology's price, hit the like button and subscribe. The rising cost of everyday electronics is a direct symptom of a massive financial boom and bust cycle that recently played out across Asian markets. The global obsession with artificial intelligence has broken the physical supply chain of the modern world. By early 2026, South Korea had become the absolute center of global AI investment. Trillions of dollars in foreign capital poured into the country's technology sector. This chart tracks the Korea Composite Stock Price Index. The index went vertical, shattering the 8,000-point record, making South Korea the sixth largest equity market on Earth. Then, in July 2026, the market dropped 25% from its peak in a matter of days. Everyday retail investors who had leveraged themselves to chase the momentum were caught in the slide. Over 2.3 trillion won of retail wealth was forcibly liquidated almost overnight. The July crash was the first signal that the world's digital ambitions were beginning to collide with the physical limits of its hardware. Major technology companies committed an estimated $680 billion to AI infrastructure for the year 2026. These new data centers require a highly specialized component to function, high bandwidth memory, or HBM. As we can see in this diagram, instead of a standard flat layout, HBM stacks memory vertically to drastically increase processing speeds. For the companies making these chips, the economics are irresistible. HBM generates 3 to 5 times the profit margin of standard consumer RAM. Faced with those margins, manufacturing giants like Samsung and SK Hynix made a calculated choice. They began deprioritizing, and in some cases completely halting, the production lines dedicated to conventional memory for consumer laptops and phones to focus exclusively on HBM. Top manufacturers quickly sold out their entire global supply of HBM for 2026. The most efficient production lines on the planet are now permanently locked away from the consumer tech sector. With the world's leading memory manufacturers concentrated in South Korea, the country became a singular geographic bottleneck for the entire AI hardware ecosystem. Then, a geopolitical shock hit the raw material supply chain, choking off the global delivery of helium. Helium is an absolute requirement for semiconductor fabrication. If a factory loses helium pressure, the manufacturing process stalls, and millions of dollars of active silicon wafers are instantly ruined. No amount of big tech capital can buy finished memory chips if the raw chemical inputs physically cannot cross the ocean. In January 2025, a Chinese startup called DeepSeek released an AI model that matched top-tier performance while reportedly costing only $5 million to train. This DeepSeek shock suggested that software was becoming efficient enough to potentially replace massive GPU clusters, threatening the value of the hundreds of billions already spent on hardware infrastructure. The fear that those investments might never see a return wiped $580 billion off NVIDIA's market cap in a day. That localized sell-off triggered a chain reaction across the Pacific. South Korean retail investors, heavily leveraged in domestic AI funds, were hit with mass margin calls, accelerating the market crash. The situation grew so severe that the South Korean government had to step in, authorizing a 14.9 trillion won emergency bailout to keep vulnerable small and medium-sized enterprises afloat. This graphic illustrates the brutal reality facing corporate boards. Despite committing billions of dollars in capital expenditure, roughly 95% of organizations are seeing zero financial return on their generative AI investments. This exact monetization gap forced global markets to finally distinguish between the hype of artificial intelligence and actual corporate profitability. Investors immediately drew comparisons between the 2026 AI crash and the 2000 dot-com bubble, fearing a total wipeout of the technology sector. But the underlying financials dictate a different reality. Unlike the speculative internet startups of the late 90s, today's AI infrastructure leaders are highly profitable, with NVIDIA posting over $215 billion in actual revenue. We can see this dynamic playing out in South Korea's K-shaped economy. As the top line shows, semiconductor exports are breaking all-time records. But the bottom line reveals a stagnant domestic economy and a weakened currency struggling under the weight of the crash. The corporate demand for artificial intelligence hardware is completely real. What the market got wrong was the sheer physical cost and the years of lead time required to actually build it. Because memory manufacturing capacity has been swallowed by the data center sector, average consumers are now facing spec shrinkflation. Look at the internal components of a standard smartphone in this diagram. To cut costs, budget models are shipping with less memory than previous generations, while the average selling price for flagship devices has climbed to a record $523. The ambition of the software industry has finally crashed into the hard, physical limits of our planet's supply chains. Until global manufacturing infrastructure can expand to meet this new demand, everyday consumers will continue footing the bill for the AI supercycle. If this breakdown helped you see the markets differently, please like, share, and subscribe.